Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Good old Santa Claus looks as if he plans to leave lumps of coal in some stockings this year. That nice rally that we had been enjoying has given way to a sharp setback, and much as it pains me to say so, I have to say that this market looks as if it's planning to head lower, led by those self-same NASDAQ stocks that have been market leaders on the way down all this year. Not to despair, however, our market index work is showing us where, but alert, not necessarily when, a powerful rally point lies ahead. This will be our last FANG Friday of the year. So today I am going to review our performance on a stock-by-stock basis for the year. Of course, I will also take a moment to update you all to let you know where these stocks stand today and what we expect going forward from here. It has not necessarily been a pretty year for investments or for investors on the long side of the market. The NASDAQ notably. But the simple secret to avoiding trouble has just been to avoid poor values, not necessarily being out of the market. A goodly number of stocks have actually had a pretty good year. So, despite what you've seen this year in our FANG Friday webcasts, we are not perma-bears. We are perma-value investors. And with one irksome exception, Apple, this is how we have approached the FANGs in 2022. Now, 2023 may be somewhat different from this year, but from where we sit, perhaps in magnitude, but probably not in direction. When we started the year, the NASDAQ 100 was sitting just about right on its HB1 price. That's 9.5 times adjusted book value, a valuation extreme last seen in 2000, from which heights that index lost nearly 80% of its price before it hit bottom. At the beginning of this year, the FANGs were sitting at valuation extremes as well. In some cases, the same extremes that they had reached in 2000. So it was not that difficult to ascertain which way they were likely to go, although we did need our SVA methodology to confirm our judgment. Speaking of which, remember that I said that early in 2023, specifically January the 6th at 4:15 p.m., I would be conducting a free and public, full-scale, hour-long introductory webinar that outlines our service and its underlying methodology that you can attend live for free. Registration is closing at midnight on Saturday or Sunday evening. You must register before then. Last chance to give your portfolio a nice Christmas present. And if you do wish to register, please remember to send us an email with your full name to info@strategicanalysis.ca. We will be sending out confirmation emails to all participants, and we'll be sending you an instructional email on how to attend the webinar, which we will send on the morning of January the 6th. But let me say it again, in the interest of full disclosure, SVA is a do-it-yourself investment service, and we do not attempt to spoon-feed you every step of the way. I will teach you how to examine and analyze stocks using SVA, but we track 3,000 stocks, and we cannot tell you what to do in every, let alone any, individual case. It takes time and effort to become comfortable with the service. Although, for those of you who have been faithful FANG Friday viewers for some time now, I suspect that you have a pretty good idea of what's involved. It's clearly not for everyone. However, if you are ready to take that next step Now to investment independence. It can be a tremendous benefit to your investing future, as the performance results of our FANG Friday stocks in 2022 clearly shows. Now, before we take a close look at those FANGs and what's going on, as always, I do like to say thanks to everyone who likes this video and all our subscribers. We've managed to miss most of the carnage among the FANGs, and have even managed to catch one or two of the bounces as well. For FANG Friday subscribers, this has actually been a pretty good year. And it would have been better still for anyone who has gone short the FANGs that SVA told you to avoid. I do not recommend short selling in our client service, so I did not raise that issue. But the opportunities were there, and there in spades this year. And the question is, what lies ahead in 2023? So on a stock-by-stock basis, let's review the FANGs, and then we'll see what you should be watching for until we meet again in the new year. We'll start with Amazon. And Amazon has come down in two waves of roughly 37% each. Remember, the HB2 had been a long, a 10-year valuation low, and when it broke, we had a sell recommendation on the stock, and we put a buy recommendation back on the stock when it hit its bubble price. So 2 breakpoints down, that was 37%. Had a nice rally, but after breaking out and trying to hold, it broke back again, and I put a sell on the stock, and it has been in that mode ever since then. In this latest market rally, Amazon wasn't even trying. Look at that, eh? Everything else is doing very well. What's Amazon doing? Nothing. It had a miserable sideways sort of move, but the game's over, folks. $80, its mid-super growth price, or 5.5 times book value, is coming up. But $65, its low super growth price, or 4.5 times book value, and likely worse, looks to be in the cards. I confidently expect to see the super growth price for the shares, or 3.5 times book. Now, what should you be watching for until we reconvene in the new year? If the MSG price fails, look for another step down to its LSG price. Tesla has been a bit nerve-wracking this year, but we finally saw a solid, safe sell on the stock when it broke its HB4 price at 250, and is now down a full 50%, and I think very clearly heading towards its bubble price. What should you be watching for until we reconvene in the new year? The pace of the decline of Tesla has actually picked up speed, which suggests to me that the bubble price, which is $106, is unlikely to hold. Breaking that level, however, leads us to a deep, dark space. Alphabet was a clear sell at its bubble price, and Microsoft, by the way, was a clear sell at its HB3 price, or 16 times book. They're both down 38 and 30% respectively, about in line with the NASDAQ 100. Recently, they were clinging like cloth to their critical breakpoints, but both have let go. What you must watch for until we reconvene next year: Alphabet is likely to at least have a bounce off its super growth price. So you might get a bit of a trade here, as the super growth price is very powerful support indeed. Microsoft is likely to get a bounce at its bubble price, which is $195 right now. So I think you can book both of them for a potential rebound. Now, Meta was a clear sell at its bubble price. Okay, it had been the third time that it reached there. Did not have supporting fair market value. Absolutely a clear sell, and it bottomed roughly just a little bit below its growth price, or about 2 times book, for a total loss of 73%. It has since enjoyed a 1 breakpoint rebound, but looks to be kind of running out of gas as far as I can see. Now, what you must be watching for until we convene next year, I personally would not be holding Meta shares right now. If they manage to break out over their mid-growth price, or 2.5 times book, it would certainly be promising. But otherwise, I expect a return to its growth price. If that fails to hold, however, hit the silk. I don't know that this stock can go its own way alone for long without the rest of the FANGs. Netflix plunged almost 80% following my sell when it broke its HB3 price, or 16 times book value, and bottomed roughly at its super growth price, although it was not as precise as as most stocks usually do, which I've observed, I think, several times. It's had a nice rebound, and it has managed to close that trading gap, following its collapse through the bubble price. I am still wondering whether those shares want to go that high, to the bubble price that is, or whether closing the gap was enough. What you must watch for until we reconvene, if the mid-super growth price, 5.5 times book value, fails to hold, do not hesitate to sell. As far as Nvidia is concerned, we got a perfect sell at its HB6 price, or 33 times book value. Its valuation high that stretched all the way back to the year 2000. Now, I missed this entire rebound from its lows because of a violent change in the balance sheet, which we only got too late to take action. But after reaching up precisely to its HB4 price, or 20 times book, it has set rapidly back by some 27%. So I have clawed back a lot of that gain that I missed, and in very short order. What you must watch for until we reconvene, if the HB3 price fails to hold, as I suspect will happen, by the way, the trip down to its bubble price, which I promised you sometime, I think will undoubtedly transpire. Last, and certainly not least, Apple remains everybody's favorite stock, and their share buyback program has kept the stock valuation higher than it actually merits. Apple has only lost about 23% versus the 31% loss for the NASDAQ 100. So I was perhaps right not to bail out, but that did not offer much comfort. As a former partner of mine at Scepter Investment Counsel once observed, relative performance can sometimes make for some tough chewing. As long-term viewers know, I have not cared for this stock at these extreme levels, and I certainly do not fight City Hall. I do not like the Dr. Fell. Why it is, I cannot tell, but this I know, and know full well, I do not like the Dr. Fell. What you must watch for as we read before we reconvene in the new year, you can try to do as I try to do with this wretched stock. Extend, that downtrend line for the HB6, or 33 times book value, and try to guesstimate where a breakdown might occur. Otherwise, do as I intend to do. forget about it. Now, in brief summary, be aware. The NASDAQ 100 has not found a sustainable low, and I need to emphasize that I have never seen a solid market bottom that has not come until one of our key SVA breakpoints has been reached, and we can see some solid upside potential being reflected in those fair market value lines, those dotted lines on the charts. Shorter term, I can promise you that a really good trading opportunity lies ahead, so I suggest that you stay tuned. We will not be having a FANG Friday webinar during Christmas week. That is, unless something untoward happens. But I will be back in early January, of course, first with our how-to webinar on January the 6th, and then we'll be back with our regular editions of FANG Friday, restarting on the 13th. For now, this has been Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you on January the 13th. In the meantime, I want to wish you and all of yours a wonderful holiday season and a profitable new year.